I think the war is another positive for gold, just improves the fundamentals. But so far, the war has been a catalyst for a correction in gold. Gold peaked out just before the war started and sold off. And some of that was buy the rumor, sell the fact, because part of the reason for the big run up in the price of gold leading into the war was the anticipation of the war. Oh, well, maybe gold's not a safe haven. Look, it's gone down. Gold did pull back, and I think it's consolidating and getting ready for another breakout, and I think it's going to run to new highs. I think it's going to be above 6,000 before the end of this calendar year. And it's, at 4,800, it's a good buying opportunity now. One of the reasons the war is positive for gold is because wars are inflationary, not just because of the war itself, but because of the way we pay for them. We pay for wars by running big deficits, and then the Fed prints money to buy the bonds to keep interest rates from rising. And so it's inflation. Silver got all the way up to $120 an ounce. So it pulled back to around 70, and as we're speaking, it's back above 80. Silver is a massive breakout.
How are you seeing this sector at this moment, Peter? So I have spoke to some analysts that believe that gold is very stretched from all of the other assets and that this run could be finished. How do you see it?
No, I think gold is still relatively undervalued. Gold has gone up quite a bit in the last few years, although it's pulled back, pretty substantially since its peak in late February. But I think gold's move was just kind of catching up to where it should have been years ago, given all of the money that the Fed has created and other central banks. I don't think gold kept pace with that amount of inflation, but it's caught up, or maybe it has a little bit more to go, but we're going to create a lot more inflation. So the price of gold is going to have to continue to rise to reflect the debasement of fiat currencies, and in particular, the debasement of the US dollar.
Right. And so, Peter, do you see a possibility where gold could stay relatively flat for a few years because of the magnitude of the run that we have seen?
No, I don't think it's going to stay flat. I think it's going to continue to rise. Maybe if the Fed were to aggressively hike rates and shrink its balance sheet, but that's not something that I expect to happen. I think the Fed is more likely to reduce rates and step up the pace of quantitative easing.
The Fed keeps calling inflation contained, while gold keeps behaving like the monetary system already broke behind closed doors. Peter Schiff notes that central bank balance sheets never truly normalized after the last crisis, yet investors still price assets as if cheap money was temporary. That contradiction matters because gold isn't reacting to headlines anymore. It's repricing decades of currency dilution in real time. Savers sitting entirely in cash are quietly absorbing the cost of policy failure through purchasing power destruction. Next, Peter Schiff exposes why silver's delayed breakout may be a far bigger warning signal than gold itself.
So, if anything, I would expect not only gold to keep going up, but the trajectory of the ascent to increase as well.
What about silver, Peter? Do you see silver as sort of gold on steroids? And do you believe the industrial side is important, or do you think it's mainly still the monetary side that drives silver with gold?
Well, I think it's going to be driven by both. And I do think that the gain percentage-wise in silver is likely to exceed the gain in gold. That's typical. And silver started to make its catch-up move even later. Silver, even a year ago, was only about $30, and then it quadrupled very quickly between late last year and early this year. Silver got all the way up to $120 an ounce. Now, it pulled back to around 70, and as we're speaking, it's back above 80. Silver is a massive breakout. It took silver a lot longer to break out than gold, but now they've both broken out, and I think we have a bull market in precious metals. And it's not just silver and gold, it's platinum, palladium. All of these metals were lagging. Gold kind of was a one-man band when it comes to precious metals, or when it came to precious metals, up until last year. And last year, we finally saw the other precious metals follow gold's lead. And now it's just a general bull market. And in that bull market, you would expect the gold gains to outpace, the silver gains to outpace the gold gains.
Silver didn't explode higher because retail suddenly became smart. It moved because institutional positioning finally stopped fighting the trend. According to Peter Schiff, silver's breakout lagged gold for years, which historically happens near the later stages of monetary distrust cycles. What's unusual this time is that industrial metals, monetary metals, and energy-sensitive assets are rising together, while central banks still publicly insist inflation expectations remain anchored. That divergence usually ends with policy credibility collapsing faster than investors expect. Next, Peter Schiff reveals why mining stocks still haven't priced in the metal rally everyone can already see.
Yes, well, what about mining stocks, Peter? So we have seen these big high-quality companies printing cash. The recent reports came out, they're doing fantastically. So do you see them even as a better opportunity than the metals themselves?
Yeah, I think they've lagged even more than the metals themselves, because I think there's been a lot of skepticism in the investment community about the gold rally and the silver rally. And so investors have been reluctant to fully price in the move into the earnings estimates and therefore into the stock prices. So I think the best opportunity for big gains is in the miners. You're going to get big gains, I think, in the metals, but you'll get even bigger gains, I think, in the miners if the big gains in the metals actually pan out. So that's where most of my money is. I think that the big play is buying these mining companies, which I think are even more undervalued than the metal. And, we manage a lot of money at Europe Pacific Asset Management. We have strategies that focus on miners in addition to our other broader strategies on dividend paying and value stocks and emerging markets. And we manage a gold fund, too, that focuses all on gold and silver mining companies and also has a large allocation to the smaller ones, which is where even better opportunities are. There's great opportunities in the large cap gold miners, but they're even better when you go down the food chain to the smaller ones. So we have a good diversified portfolio of those in our gold fund. So people should check it out. The symbol is EPGIX. That's the no load symbol that you can get at any discount broker, or you can go to Europac.com and get information on my separately managed accounts and on that mutual fund.
Most investors think owning gold protects them, but historically the real wealth transfer happens one layer beneath the metal itself. What Peter Schiff is highlighting here is that mining companies are generating record cash flow, while many funds still value them, like gold is stuck years lower. That disconnect suggests institutions either don't believe the rally is real or expect central banks to regain control quickly. If they're wrong, miners become one of the few sectors where earnings growth and monetary panic collide simultaneously. Next, Peter Schiff unravels why war headlines may actually be disguising a larger currency problem.
Yes, of course, Peter, we need to cover the Iran war, the Strait of Hormuz shock that we're seeing right now. So some people see that US is sort of isolated from all of this because they're big producer, but weaker Europe and weaker Middle East cannot be good for US as well, right?
Well, I think the war is actually another positive for gold, just improves the fundamentals. But so far, the war has been a catalyst for a correction in gold. Gold peaked out just before the war started and sold off. And some of that was buy the rumor, sell the fact, because part of the reason for the big run up in the price of gold leading into the war was the anticipation of the war. It wasn't a secret that it looked like we may have a war with Iran based on the troop movements, based on, where the ships were and the rhetoric. So the markets kind of got ahead of the war. And by the time the war started, you had profit taking, which, is typical. Buy the rumor, sell the fact. That's not unique to gold. That kind of happens with most markets. But the sell-off in gold that followed the outbreak of the war got a lot of people to think, oh, well, maybe gold's not a safe haven. Look, it's gone down, because of the war. And I think they missed the forest for the trees because the big move happened right before the war. But Gold did pull back, and I think it's consolidating and getting ready for another breakout.
Markets sold gold after war headlines intensified. Yet energy risk, deficit spending, and geopolitical instability all moved sharply higher at the same time. Peter Schiff's argument suggests investors misunderstood the correction entirely because the metal had already priced in the conflict weeks earlier through quiet institutional accumulation. Media narratives focused on the short-term pullback while ignoring the larger inflationary machinery wars always activate behind the scenes. The real danger is assuming temporary price weakness means the macro thesis disappeared. Next, Peter Schiff exposes why wartime spending may force the Fed into another hidden easing cycle.
And I think it's going to run to new highs. I think it's going to be above 6,000 before the end of this calendar year. And it's, at 4,800, it's a good buying opportunity now. And, the war, one of the reasons the war is positive for gold is because wars are inflationary, not just because of the war itself, but because of the way we pay for them. We pay for wars by running big deficits, and then the Fed prints money to buy the bonds to keep interest rates from rising. And so it's inflation. So we're going to get more inflation because of the war. And that's good for gold. And the war is going to weaken the economy as well because it makes energy prices go up, food prices go up. And, that puts a damper on economic activity because when you spend more money for food and energy, you have less money to spend on discretionary items. And so you see a downturn in those areas of the economy and a pickup in layoffs. And so, that also leads to bigger budget deficits and more money printing and more inflation. All roads seem to lead to more inflation, which lead to gold.
Right. But because the US economy, Peter, depends so much on the stock market, if we do get problems, do you see if stock markets do go down, could that bring temporarily slowdown in inflation or even deflation, which then be, sort of reacted by the Fed with more inflation?
No, I don't think stock prices going down are going to have much of an impact on inflation.
The market still treats inflation like a supply problem, even while governments finance geopolitical escalation with expanding debt issuance and monetary intervention. This is where Peter Schiff's thesis shifts from commodity analysis into systemic risk, because wars historically force central banks into politically impossible choices between currency stability and economic support. Rising food and energy costs don't hurt hedge funds first. They pressure households already stretched by years of real wage erosion. Investors waiting for deflationary relief may discover policymakers fear recession far more than inflation itself. Next, Peter Schiff reveals the hidden reason stock market weakness could accelerate money printing, not stop it.
If stock prices fall far enough, that might in and of itself get the Fed to act with, bailouts and rate cuts and QE, which would have a positive, or not a positive, but an impact on inflation in making it go up. So it mainly depends on how the government reacts to a falling stock market as for its inflationary implications, not the stock market falling just, in and of itself.
Right. And if you look at liquidity, Peter, so would that mean most of your liquidity would not be in cash and would be sort of in gold?
Well, I think that's where investors should keep their liquidity. I think it's much better in gold because it's not being debased. I think that dollars are problematic to hold because the longer you hold them, the less they're going to buy. So you're losing money over time by holding on to dollars. And that's true for most fiat currencies, probably all of them. I think it's just particularly true right now for dollars because I expect a major dollar decline in relation to other foreign currencies. The war kind of slowed down. The dollar had a very weak 2025. And I think the dollar would already be much lower now had the war not started. So the war, gave the dollar a bit of a temporary reprieve. But, it's not a stay of execution. Right? Or there's going to be an execution, whether we stay it or not, maybe is what I meant.
The Fed claims it fights inflation. Yet every serious market decline still gets answered with liquidity injections and emergency support. Peter Schiff notes that the real inflation trigger is not the crash itself, but the government response that always follows when asset prices threaten the financial system. That creates a dangerous illusion for savers holding large cash positions because currency debasement compounds quietly, while headlines focus on short-term volatility. Gold isn't simply an investment in this environment. It becomes a defense against policy reflexes investors already know are coming. Next, Peter Schiff reveals why central banks are abandoning dollars faster than retail investors realize.
So I think that when the dollar resumes its decline, that's going to be an even bigger impetus, right, for inflation and the rising price of gold and silver.
Peter, I recently spoke to your friend Adrian Day, and he mentioned, the importance of Tether buying a lot of gold more than any other central bank. Do you think that's an important development?
Well, I don't know exactly how much Qatar bought, but I expect more central banks to get in on the gold buying game. Central bank gold buying is what really drove the market in 2025 because retail investors, private investors, were selling gold the whole way up. It was the central banks that were buying it. And I think they're doing that for a particular reason. They're trying to de-dollarize. And when you're getting out of dollars, de facto, you have to get into something else. And the euro is not that great. Neither is the yen or the pound or, RMB. So the most natural alternative for the dollar is gold. And that's the alternative that central banks have been opting for. And I think the central banks that have been moving dollars into gold are going to continue to do that, not only this year, but for many years in the future, regardless of where the price of gold is, even if it's significantly higher. And I think that private investors, both institutional and retail investors, are going to be moving in that direction too.
Central banks accumulated gold aggressively, while retail investors were still being told inflation was transitory and fully under control. According to Peter Schiff, that institutional buying wave was not speculative positioning. It was preparation for a weaker, dollar-based system over the next decade. The uncomfortable reality is that governments publicly defend fiat credibility while simultaneously diversifying reserves away from it behind closed doors. Investors ignoring that contradiction risk being the last participants, still anchored to depreciating paper assets, while official money quietly migrates elsewhere. Next, Peter Schiff exposes the hidden supply problem that could send gold prices into a completely different phase.
Diversifying their investment portfolios, diversifying out of their treasuries into gold. Even forget when it was a year ago or, less than a year, that Morgan Stanley came out and said, hey, the 60-40 portfolio should be 60 stocks, 20 bonds, and 20% gold. And to the extent that private investors, banks, advisors start to recommend that people own fewer bonds and introduce gold into their portfolio as a better hedge, that's a significant development because central banks are already doing just that. They're moving more into gold and out of the currencies or out of treasuries. And so the private sector should be doing the same thing. And if they are, that's just going to put even more upward pressure on gold because gold prices went way up as the public was selling gold and the central banks were buying it. But if the public stops selling and starts buying in competition with the central bank, where are the sellers going to come from? There's not many. There's the gold mines that they're in the business of selling gold. So they're mining it and selling it. But if that's the only supply that's going to be coming out of the market, the price is going to skyrocket because annual production alone is not enough to satisfy this demand. So in which case, it's not a buy the rumor, sell the fact. It's a buy the rumor and then sell because it turns out the rumor was false. And that could be an even bigger sell-off than if the rumor turns out to have been true. So I think you need to be cautious when it comes to stocks in the U.S.
Wall Street spent decades convincing retirees that bonds were safe. Yet institutions are now quietly rewriting the classic 60-40 model in real time. What Peter Schiff is highlighting here is that central banks already front-ran this shift by rotating reserves into gold long before financial advisors publicly acknowledged the problem. If retail investors begin competing with sovereign buyers for limited physical supply, pricing pressure could become disorderly very quickly. That matters because annual mine production alone cannot absorb a broad portfolio migration out of paper assets. Next, Peter Schiff unravels why the dollar's recent rally may actually be masking deeper structural weakness.
But this pullback in gold and silver, I think, was a gift. In the mining stocks, they've had a huge rally these last couple of days, but they're still way below the highs that they hit in February. So you've got, good buying opportunities in that whole segment. And, the dollar did rally. There was a flight to quality rally in the dollar that has fizzled. The dollar has now lost everything it gained because of the Iran war, but the dollar still has a lot of lost ground to surrender, and it will surrender this ground, or ground that it gained in the past will be surrendered. And as the dollar weakens, that's also going to play into these themes. And that's why people should be invested abroad, not just in gold and precious metals, but in foreign stocks, emerging markets. They will benefit from the weakness in the US dollar.
If this war continues for longer, Peter, what would that mean for Europe? I mean, they would be in big trouble, right?
Well, yeah, it certainly is disruptive, more so in Europe, because a lot of their oil is flowing through those straits. But I think the more significant development may be the U.S. in its loss of influence in the region. Because if we fail to achieve our objectives in Iran, and so far we haven't achieved any of them, but if we fail, I think that our reputation is harmed. And it may leave Iran in a stronger position in the Gulf. And it may mean that our allies further distance themselves.
The dollar briefly surged during the geopolitical panic, but that move faded almost as quickly as it appeared. And historically, that pattern matters. Peter Schiff's argument suggests the market used war headlines as temporary cover for a much larger repricing already underway beneath the surface. When safe haven demand fails to sustain a currency rally during conflict, it often signals declining confidence in the system backing that currency itself. Investors focused only on short-term volatility may be missing the broader shift toward international diversification and hard assets. Next, Peter Schiff reveals why weakening US influence could accelerate the global move away from the petrodollar.
We may not have as many bases in that area as we had before, and the dollar's influence may decline. More nations may start moving away from dollars, and so the whole petrodollar could collapse. So this has big implications for the U.S. beyond Europe or Asia. Japan is influenced a lot by this too. But oil's a global market, and there's still oil that we were importing, even though we're a net exporter. There was your oil that was coming here that could end up going to Europe instead of coming to the U.S. And more oil that we produce here could be shipped over there. So it means higher prices, but not just for Europeans. It means higher prices for us too. Because if oil that we could have consumed is shipped over to Europe, well, then we have to pay higher for what's still here.
America became a net energy exporter. Yet consumers still remain exposed to global oil shocks because pricing power never truly left international markets. This is where Peter Schiff's thesis shifts from geopolitics into monetary risk, because the petrodollar system depends heavily on global trust in US influence and financial stability. If allies begin reducing dollar dependence while energy trade fragments into regional blocs, inflation pressures become much harder for policymakers to contain domestically. That directly impacts retirees and savers through higher living costs long before official data fully reflects the damage.